following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program designed for busy financial advisors who are interested in finding new ways to incorporate options into their portfolios, as well as for many of you out there who are interested in perhaps finding a new advisor or switching advisors or getting a financial advisor for the first time, and you want to know what skill sets should those advisors have, particularly when it comes to options. Well, this is the program for you. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network, upon which many of you are listening to this fine program right now. And I am joined on the program, as usual, by my compatriot, my boon companion over there from the Options Industry Council. He is their Director of Education, good old Mr. Alan Grigoletto. Alan, welcome back to the program.
Well, thanks, Mark. It's always a pleasure to be back. And we begin a new year here in 2014, and lots of exciting stuff happening out there.
All right, and we are also joined, as always, by good old Mr. Mark Sebastian. He is the Director of Trading and Investments over there at Swan Wealth Advisors. Mr. S., welcome to the program, sir.
Hey, thanks for having me on. Great to be here.
All right, and with the whole gang finally assembled, we're going to start off with our first segment, our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. As the name implies, this is the portion of the program where we break down a basic options concept or idea or indeed a product and tell you how you can incorporate that into your own client portfolios. And as we were discussing what we should talk about on today's Options 101 segment, we kept coming back to a product type, a new product category that really we thought would interest a lot of the financial advisors and the active asset managers out there, as well as a lot of the clients of those advisors. We're talking about mini options. Now, you may not know or be familiar with these products. They were just launched recently. They were launched in March of 2013. That followed up on a lead up. They were announced essentially in April of 2012. So you're talking roughly a year from inception to approval to actually launching. That may sound kind of slow to you, but for the options world, that actually is lightning fast to have a product go from concept to actually in the marketplace in such a quick turnaround period. That actually is pretty impressive. And what we're talking about here, well, as the name implies, these are essentially smaller sized, almost bite-sized contracts, if you will. If you've listened to any of our earlier programs, you know that the standard size for a typical equity and index options contract, the multiplier, the term we use for that, is 100. That means for each options contract that you trade, that is on 100 shares of the underlying stock or the index. That is a useful number. It's a useful amount of shares. Most people want to trade in round lots. But then again, when you get to some of the pricier ones, that perhaps may not be feasible. And that's where really the minis come in handy. The mini options, as opposed to being contracts on 100 shares of stock or the underlying, they're actually contracts on just 10 shares. So they're really just 1/10 size contracts. Now, Al, I know you guys over there at OIC have been a part of this push to help get the minis out there to the broader populace. What's your take on the minis so far? What you think of the product, and then also what's some of the response you've seen from some of the advisors out there when you go out there and talk to them about the minis? Are they interested in them? Are they even aware of these products? Or what's been the perception in the marketplace so far?
I would categorize it, Mark, as kind of a slow adoption, whereas the weeklies caught on very, very quickly. The short-term options caught on very quickly with multitude of users. I think the minis has had probably a slower adoption rate. Part of that was that a lot of the coding that was necessary to do minis got hung up a little bit in the queue of delivering the capability to be able to execute these at some of the major firms. And so we didn't get a complete rollout by all of the users. Now, the discount brokers, of course, embrace the mini options, and for good reason. A lot of their clients held very small number of shares in some high-price securities like Apple and Google and the gold ETF and a few of the others like Amazon and SPY. And so, therefore, it made perfect sense to give them the capability to be able to do a covered call on a high-price security where they owned less than 100 share holding.
Yes, exactly. And, for our listeners who still may be scratching their heads, these products are essentially identical in just about every other way to a regular options contract. So they'll have the same underlying, they'll have the same expiration cycle, they'll have the same strikes. Just about everything else will be essentially the same except for the multiplier. So instead of getting 100 shares for that option or hedging 100 shares, you're only talking about 10. So as you might imagine, that's more useful for some of the higher priced names. And that indeed is where the focus of the minis was and really still is to this day. When the SEC approved the minis, they approved them on essentially 5 underlyings. They approved it on Apple, probably the primary use case for minis, and the example that a lot of people put out there when they were talking about minis is that, hey, Apple is $400, $500 plus dollars, depending on when you're looking at it. That's a great name. A lot of people want to trade it. A lot of your clients, I'm sure, want to trade this product, but it's expensive. Not everyone can afford a round lot of 100 shares in a $400 or $500 or even more expensive name. So the minis are an ideal use case for that one. They also approved it for Amazon, another pricey name. They approved it for Google. Of course, that name trading over $1,000 now, or close or around that level, depending on when you look at it. And then the SPYs, the S&P 500 ETF, and a commodity ETF, actually, GLD, a very popular name as well. So as of now, the minis were essentially approved for 5 underlyings: Apple, Amazon, Google, SPY, and GLD. So if your clients trade one of those, and probably most of your clients have at least one of those in their portfolios, then this is a good use case for you. And again, let's look at some of the use cases for these products when you'd want to use them. Let's say, for example, you have a client who's sitting on 40 shares of Apple in their account. and they come to you and say, hey, what can I do with this? I don't have 100 shares, so I can't write a call on it. I can't buy a put on it because it's just extra premium that I don't need. There's a lot of issues with that. But now with the mini, he could actually write some calls on it and generate some income on it. That's what he chooses to do. 40 shares of the underlying equates to 4 minis. And so it works out fairly well in that sense. Same thing on the flip side. If he wanted to hedge that with a put, he can go out and buy 4 mini contracts, whereas he still couldn't even buy one of the large contracts. And of course, as Alan said, there were a few issues in the rollout of these, so which is one of the reasons why we've held off discussing them on this program until now. We were hoping that some of the bugs, some of the kinks would be worked out of the program by now. Fortunately, a few of them still remain, which is why they're not perhaps just yet, the ideal tool for everyone out there. A couple of those problems. First off, what we've seen, a lot of the feedback initially on these has to do with the commission structure. Is a lot of people saying, hey, this is the 1/10 size contract. I'm clearly not getting the same notional value or premium that I'm getting from a big contract. Yet the commission charges are the same. So a lot of people are having pushed back on that, saying, wait a minute, I should be getting some sort of reduced commission level to trade these things. And yet so far, unfortunately, that isn't the case. A lot of the brokers are still trying to work out their pricing on these names. So if you are indeed looking at trading these and you're going to do some size on behalf of your clients, it's certainly worth contacting your brokerage provider and saying, hey, what can we do to work with some of the commissions on these? Ticket charges is another issue. If you trade options, you have that primary ticket charge when you open up a trade. In this case, if you want to, let's say, combine minis with regulars, let's just say you want to combine, let's say, 5 regular contracts with 5 minis. You would be charged a ticket charge for the 5 regular contracts and then a ticket charge again for the 5 minis. They don't combine those two in most of the systems out there. So again, that's another process, another problem that is kind of hindering the adoption rate of these. And then also probably the most difficult one, and this speaks really to, I think, some of the systemic issues that are plaguing the options industry overall, and that is essentially the spreads on these products just really weren't where they needed to be. They were far too wide, particularly when they launched. If you wanted to trade a mini option, you really were incurring a much larger bid-ask spread, a much larger transaction cost than you were if you were trading the regular size contract. So as a result, if you wanted to trade a mini, you were paying more for the spread. You were paying the same amount for the commission. You're paying a full ticket charge. So you really had to want to do a mini because you were paying, quite literally, for that privilege. Those spreads have come in a little bit, but we're still seeing some issues with those spreads. Another reason which has held up some of the adoption of this. Now, Alan, you mentioned some of the behind-the-scenes programming and coding issues that hung up the minis. Are you still seeing some pushback and some issues and some complaints around these issues that we just highlighted? The spreads, the commissions. Is that a bit of a sticking point still for the advisors that you're talking to?
So you're correct, Mark. I think most of the bugs in getting this thing through the queue and making it applicable for users has been solved. But what it comes down to at the end of the day is the cost associated with executing a mini. For the listeners out there, they need to know that when they pull up a quote on a mini, it's always followed by the number 7, which denotes it as being a mini contract. And I think also, as you duly noted, we don't have a lot of underlyings for the mini at this moment. So I think as we start to roll these out across more and more classes, we'll see greater usage, and I think some of the cost issues will be solved down the road.
Of course, you mentioned the underlyings. You guys, OIC, are part of the Options Clearing Corp, the OCC, so you get to see a lot of these other initiatives that are cooking out there. And I know there's been a slow rate of adoption for the initial round of minis. Has that kind of stymied any talk of adding additional classes, or are they still filing for approval for new classes right now to add additional names and series to the minis going forward?
I think the demand is there, Mark. I'm not certain where that lies in the queue of things to do, but I think the demand is definitely there from the brokerage community to continue to roll these out. So I would expect that, by the mid-year, we'll know more on that front. We can talk about that maybe later on in another one of your shows and give the listeners an update.
It's unfortunate. At least we still have to kind of play the wait-and-see game with minis. I mean, we've already been waiting for essentially 9 months, hoping that a lot of these issues would resolve themselves. Again, still many of them plaguing the minis, unfortunately. That doesn't mean you shouldn't trade these products. If you have a lot of clients sitting on a lot of odd lot positions, it could be worth your while and it could be worth the expense, because otherwise the alternative is really doing nothing from an options perspective.
That's right. And obviously with the commission structure and the ticket charge, it doesn't bode well for a lot of repetitive style trading, but it does. That's a small cost to pay if you're just doing a one-time hedging on one of the underlyings, and certainly we wouldn't want to discourage users out there from hedging their instruments if they have a certain forecast for a particular high-price security, and that forecast might be that it's going to drop precipitously. You certainly don't want to discourage them from buying the protection.
Exactly. If one of your clients is sitting on 60 shares of Apple and they're a bit concerned about the near term, you don't want to put them off buying some protection for the next 3 or 6 months. It's worth that extra incurred cost. And hopefully, like we said, the brokers will get it together and start realizing that they need to be a little bit more flexible on their commission structure. I mean, also, too, from an execution perspective, these products are hard to find still on a lot of brokerage platforms and indeed a lot of the advisor platforms. You really have to dig to find the mini tab in a lot of the major options platform, which is another impediment to these. If they were easily accessible right alongside the standard options chain, that would be much easier to execute these things. And you're right, the nomenclature is a little bit different. They have a 7 next to them. It's all a little bit confusing. So there still are a few things that need to be worked out. Hopefully, indeed, the market-making community will rally around these as well. It's kind of caught in that catch-22 right now of the firms don't want to commit the resources until they see the volume. The volume won't come until they actually commit the resources and tighten the spreads. So hopefully one of those two will break first and they will make a move towards the middle, and we'll see tighter. We're already seeing improvement there. We could still see some more, obviously. It's not as bad as it was back in March when they launched, when these things were, you could pretty much drive a truck through these markets. But still, it's an interesting use case, an interesting product. We wanted to be sure to at least make you aware of them when you're looking at the tools you have in your advisor arsenal from an options perspective. Many should certainly be in the conversation, but you definitely want to be aware of these caveats that we're putting out there for you when you're considering adding minis to your clients' portfolios. All right, and Mark, we've talked a bit here, Alan and I, about the different, the launches and some of the use cases for minis. I know minis probably aren't as much your bailiwick over there at Swan, because you guys are looking to do a little bit more size when you're constructing overlays and the SPX and things like that. But, that aside, what's your take on the minis right now, how they stand in the marketplace, and the use case an advisor may want to put them to?
Well, I think what they really offer is the way for an advisor to set up a hedge for a smaller account that maybe wasn't available to them in the past. If you've had a customer that had an odd lot number of stuff in an ETF like Spider or in some other ETF to Diamonds, there was really no way to set up a hedge for that person. So, looking at today, the S&P 500 is touching an all-time high today. If I'm mom and pop and I've got, $9,000 that I want to invest in the market, but I'm looking at things and I'm saying I'm really afraid of putting money into the SPY, but I also don't want to miss out at the top. Now mom and pop have a way of being able to get long the broad market and hedge themselves in SPY mini options or in a name like Apple or something like that really wasn't available to them. So, I'm excited that the option markets have adapted to, put up a fight for the little guy. And I think that's really where they have a lot of use.
Have you been watching these markets? I mean, they're kind of being derided for having spreads that are, shall we say, a wee bit generous. Is that still your take on the spreads out there in the minis?
Yeah, well, yes, but you got to understand that there's a cost associated with those minis that maybe isn't associated with, a big option. A market maker needs to do 10 times as many contracts to produce the amount of quote unquote edge that he gets out of one contract, and there's no guarantee that that's what he's going to get. So are the markets a little wider? Yes. Is that the end of the world? Not really, and it's okay. For a hedge, the market maker needs to be able to kind of pull things together. So that's really kind of the key, is that you got the market maker has a higher margin on these, and there's less liquidity in them. So that's probably why there's more width, and that's why we're okay with it.
As always, generous to the market maker, sir. I like it. All right, that's going to do it for our Options 101 segment, and now we're going to keep on rolling right on into our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, and welcome to our Tricks of the Trade segment. This is where we break down some of the practical tips and tricks for implementing options into your client portfolios, and also for a lot of you out there who are looking for advisors, shopping for advisors, what things you should be looking for. And that's a common question we get from a lot of advisors, and also indeed from a lot of people looking for advisors, which is essentially, what is the skill set that they should offer, or what is the skill set they should be looking for in an advisor, in particular when it comes to options? I mean, all the other things you guys already know about, diversification, using the different spreadsheets to spread you across asset classes. We're not going to talk about that. That's not our realm or our purview here. We're talking specifically from an options skill set point of view. So that's what we're going to talk about today in the Tricks of the Trade. We've talked about a lot of different concepts here on this show since its launch, a lot of different strategies, a lot of different things you could do. Clearly, as an advisor, you don't need to know all of those. And as a client, you probably shouldn't reasonably expect your advisor to know everything we've talked about here on the show. But there are certain core principles that you should be looking for, that you should be offering as an advisor, and you really should be demanding as a client of an advisor. We're going to kick things off. I'll present some names. Alan will present some things. Maybe we'll debate them a little bit. But Alan, when I was thinking of this, the number one skill set that I thought it was appropriate for an advisor to have, again, taking the viewpoint most of these advisors are managing long equity accounts on behalf of their clients. So given that scenario, the number one skill set that any financial advisor really worth his salt in this environment should have is how to hedge. That's the basic skill set I think you can expect from these guys. So, Mr. Sebastian, do you concur that the number one skill set that every advisor should be able to offer their clients from an options perspective is how to hedge, how to buy that put and lock in those gains?
Absolutely. How to buy the put and lock in the gains, or how to do stock replacement with a call. That is really the key. And if you're an advisor and you don't know how to use options to hedge, you need to ask yourself whether you're in the right business, in my opinion.
I like a stock replacement with a call. One I didn't even have on the list. I didn't even go that far afield, even though that is pretty basic as well. I was just trying to stick to some of the core principles. But indeed, buying a call in lieu of buying a stock, using that capital much more efficiently, also a great skill that every advisor should probably be able to bring to the table in some way, shape, or form. And Alan, do you agree with that sentiment as well?
Yeah, I think that's right, Mark. And it comes down to hedging in two ways. It's whether you're hedging an individual security within the portfolio, or whether you're hedging an ETF, or maybe the portfolio that is resembling something like the S&P 500 or some other mainstream broad-based portfolio. So I think every advisor should probably have a good understanding on calculating how many puts are needed to hedge a particular quantity, either of a security, a single stock security, or of an ETF, or of a broad-based index.
Yes, you're right. I mean, it seems like a simple calculation, yet you'd be amazed how many questions we get coming in from advisors and others saying, hey, I have this size portfolio and this underlying in this broad-based index or ETF. I've made this much on it. I want to protect those gains. How many puts should I buy? It's a very common question. So that's a skill set you should be looking for in your advisors. They should know things that we talked about earlier on this show, multipliers and how that works into how many, and how that translates into how many shares they will exercise and hedge when they're actually putting these positions on. And we're not talking about elaborate hedges. They should be able to go out and buy a put 3-6 months out, understand and choose the strike price that locks in the amount of protection you want. They should have some understanding of the different premium levels and how much you should reasonably be willing to pay for that type of protection. We talked about that on this show in the past, some rules of thumb for what percentage of assets you should be willing to allocate towards things like hedging. I encourage you and your advisors indeed to listen to that episode to kind of get a better rule of thumb for that. But in general, the first skill set that I would look for in an advisor, and the first skill set I as an advisor would want to offer, is indeed how to hedge. If you're an advisor and you don't offer that basic functionality, particularly in this market environment we find ourselves in now, where the market's been rallying for a very, very extended period, a lot of people are pretty uneasy about these current pricing levels. We could easily see a dramatic retracement in the broad indexes. You should have that basic skill set. And if your only alternative to that is to sell and to go into cash, then you're really missing something from the advisor arsenal perspective. Now, the number 2 skill set that I would say, and Alan, you could feel free to agree or disagree, is the ability to essentially generate income from that long equity portfolio. And I broke this down into there's many different ways you can do that. I broke this down to the most popular, the easiest way. They should be able to write a covered call on a long equity portfolio. Would you concur that that is probably the number 2 option skill set that an advisor should have?
I would not only say that it's probably the number 2 skill set, but it's probably the number 1 most requested type of strategy that an advisor will come across with his clients is, how do I generate income on a particular equity or my portfolio? So yes, and it's not always an easy question for an advisor to give a quick answer. There's some calculations that have to be done. There's assumptions that have to be made. There's a lot of dialogue that has to go on with an advisor and the client, and it usually starts with a question of, are you willing to sell this stock at a price above the market? Because it has to start there. That's the risk, right, that you can be assigned on that covered call. And, advisors can pose that question in different ways. They can say, is it your expectation that for the short term, say 30 days or 45 days, that this stock is not likely to go higher than 15%. So if we sell a 15% out of the money call and we do get called away, are you comfortable with that return in that time period?
Yes, and of course there's a flip side of that too, which people are for some reason terrified of having their underlying called away, advisors and clients alike, and having that conversation of, actually, that's a good thing. That then your strategy performed as you expected, indeed as you hoped, and that's a good thing. You can have your underlying called away. You can roll the call, or you can just write it again after the expiration. The next quarter, the next weekly, whatever time frame you're using, and you can keep taking that approach. Having those calls repeatedly called away, that's a good thing. That's something you want to happen. So, if you're looking for a new advisor, if you are an advisor out there and you're wondering, what skill set should I really bring to the table here, writing calls, generating that income, that almost in and of itself, I know I put hedging number 1, but if you really want to stand out from the crowd, everyone out there has that long equity portfolio. They're mostly, all their clients are kind of in the same things. So if you want to add that extra boost, that extra bit of return, make yourself stand out from the guy down the street, the guy on the corner, the other guys on your block, then this is how you do it. This is how you get that little bit of extra bang for your buck that indeed every advisor and asset manager is constantly chasing. And Mark, would you agree with that as well, that the number 2 skill for advisors really should be how to write covered calls and essentially generate income for their long equity portfolios?
For sure. And additionally, how to manage a position that where the client doesn't want to get out of the stock and maybe it's moved more than the advisor was expecting, a la 2013. That is an important skill set that is a part of that whole discussion.
And now, Mark, I chose as my number 3, putting it all together, combining that long put with that short call, aka the collar. That's kind of the standard go-to position for a lot of advisors. Would you call that your number 3, or do you disagree and think something else should be number 3?
Absolutely. I mean, a collar and a risk reversal should be, but to be honest, what we've put together is basically, hedge of the put, create income, create a collar. Really, they're all the same thing. So it comes down to, you should understand the relationship between stock price and an options price on both put and call. And that's really the key. So understand put-call parity and how it relates to a client portfolio. And there you have it.
Now, for the number 3 skill set, we just outlined the number 1 and the number 2. Those are the basic skill sets of how to hedge, how to buy a put, how to write a call, how to generate some income. The savvy advisors, the guys you really want to be looking for, and indeed the guys you want to be when you're out there talking to your clients, can put those 2 skill sets together in constructing a position that we've talked about on this show, and indeed many of the programs on this network. The collar. I've often referred to it as the holy grail of options positions for financial advisors, because it combines both of those things that we were just talking about. It combines the hedging, the protection of the long put position with the income generation of the covered call position. Combine that all and slap it on a long equity position, and you have the collar. So, Alan, would you concur that maybe putting those together would be the number 3 skill? I know you guys have done a lot of work over at OIC studying the collar in a variety of different ways. You guys are probably the leading experts on all the different permutations of the collar out there. So would you certainly look for this for the skill set for an advisor?
Well, we have several studies on the collar, Mark, in particular with ETFs and indexes. It might interest the audience to know that Notre Dame is now conducting a study on covered calls and the collar, as well as another strategy for perhaps another radio show, the covered combo, which is selling the call and selling the put on the equity. But that particular study that Notre Dame is working on deals with individual securities. And in the past, we've never really delved into a long-term study on an individual equity. We've always kept it to fairly broad-based or narrow-based ETFs.
I'll be very interested to see how that covered combo, aka covered straddle type of study works out. Because I know you've dipped your toes in those waters in the past, but that writing the put portion, while it's very interesting, that seemed to hang up a few advisors. They didn't like the idea of getting doubly long, essentially, to the downside. But I'll be very curious to see how the results of that study and see how it compares to the collar, and also the response from the advisor community, because that is a great strategy that has been reluctantly, if not at all, embraced, if not avoided, by so many of the advisors out there. So it'd be
that's probably if you were going to have a number 4 thing on the table here, I would say the cash secured put would probably naturally follow the collar. And you're right. The cash secured put is a very, very difficult concept for a lot of people to comprehend that aren't within the industry. For us, of course, it's very common. But selling an out of the money put as a substitute for putting stock orders in below the market is essentially what you're doing, except that you get paid while you wait. So if the equity doesn't descend to the lower strike price, you get to keep the premium from selling that put. And if it does, you're buying it at that strike price, less the premium that you receive on that. So it's a very good strategy if you happen to have a client that says, well, boy, I'd really love to get in XYZ stock if it were to drop by 20 points in such and such a time frame. And instead of just putting a stock order in the marketplace, you could sell a cash secured put.
Alan, we're of a like mind on this, because I indeed have that as number 4 on my list. I was charitable. I put that as optional. I put that as an optional skill set. I thought, the most you could reasonably expect from your average advisor is to have the hedging and the income generation. But if you're really an advisor who wants to set yourself apart even more, and if you're indeed the client who wants an advisor who goes that extra level, then you're right. Writing the cash secured put is a no-brainer. That's something that pretty much everyone out there who's trading long equity and long stock positions right now, they're all familiar with a limit buy order in a stock. That's a very, very basic order type everyone pretty much uses. And if you're using those, you should be using cash secured puts instead. You're right. You're getting paid to work limit orders in a stock. It's kind of a no-brainer. And it's a great way, we talked about income before, it's a great way for the savvy advisor to boost that income even more. You write the put to get paid to get into a stock. If the underlying doesn't drop, then you just keep that income and you can keep doing those levels over and over again. If the underlying does drop, you get in at a favorable level in the underlying, the level that you wanted, and then you can then turn around and do some of the other trades like we've highlighted on this show, the wheel trade and others, where you just write the covered call and you generate income to get out of it again as well. So you're making income to get in, making income to get out. Again, you're boosting your overall returns on behalf of your clients. And it's not really a dramatically enhanced skill set you need to know. If you can understand the concept of writing a put, you can understand how to do this. And that is indeed something that the savvy and skilled advisor who really wants to take the income concept to the next level, have income coming in, income going out as well, then that's the skill set that they should offer. I have a couple other optional ones I threw in here as well, something that you could, if you have a savvy advisor, you could hope that they should offer. And that is number 5 I had. This is kind of more of a general one. It's just the impact of volatility. You don't want to see your advisor out there. It's good that if they're writing calls for you and buying puts, you don't want to see them doing it irrespective of all the other developments in the marketplace. And volatility clearly has an impact on option prices, high volatility translating to much higher premium levels, low volatility translating to much lower premium levels. You want your advisor, and indeed you as the advisor, should be cognizant of that. So you shouldn't haphazardly write calls in very low volatility environments. You should be cognizant of the volatility levels you are paying when you're buying these things. If you're buying puts for your client, you could find ways to offset high volatility levels in high volatility environments. So this is something, indeed, I put it as optional, but it is important. You should know how that volatility in the marketplace translates into the amount of money you're paying and the amount of money you're collecting when you sell options as well. Alan, would you put that on your dream skill set for an advisor as well?
Boy, that would be a great skill set if all advisors really understood the impact of volatility on option prices. It's a lot to ask of an advisor on top of all the other responsibilities that advisors have and being your tax advisor, your estate planner, your portfolio manager, if you will. But clearly, if he has even the basic cursory knowledge about volatility and its impact on option prices, that's a definite benefit, of course. And if he doesn't, it doesn't preclude him being able to do those 3 other strategies we talked about: hedging, writing calls, or doing collars. He can always use an option calculator to help him figure out how to construct a specific strategy.
Yeah, he certainly doesn't have to be the master of all things Vega and, master of time spreads and things like that. Just have a basic understanding of the correlation between volatility levels and options pricing. And once he has that, then he could know when maybe perhaps he's getting significant reward or substantial reward for the risk he's taking, or perhaps when he's not, he could find alternative means to write calls and alternative ways to generate income, or perhaps even not do it. So that's just something that's kind of a hope for type skill. And the last one I have on my optional list here, this kind of takes the concepts we were just talking about and takes them to the next level, one step beyond. And this is some knowledge of basic spreads, in particular basic vertical spreads. I think this is not too much to ask of your standard advisor. If they're comfortable buying puts, if they're comfortable buying calls or selling calls, then they should be comfortable with simple vertical spreads, because it's just a great way to reduce the amount of money that you're paying for that protection or for that speculation in a particular underlying. If let's say a lot of advisors write to us and say, well, I'm only really concerned about hedging this very near-term amount in this portfolio, hedging these gains that we just made. How can I hedge that specific amount in the index or in the underlying, whatever the case may be? And the answer to doing that is quite simply vertical spreads. So if you're an advisor out there and you're looking for ways to reduce the amount of premium that you're paying for some of these positions, some of these hedges, or if you're looking for ways to just put on cheaper speculative positions or whatever the case may be, vertical spreads are a great way to do that. They're also a great way to mitigate the risk on some of these perhaps more speculative positions. If you're not comfortable perhaps selling the cash secured put like we just talked about for whatever reason, you're not comfortable having that amount of risk to the downside, the vertical spread is a great way to mitigate the amount of risk you're actually taking. So a lot of great uses for simple, basic vertical spreads. If you're an advisor, you're using options, you should have some understanding of these. It could certainly translate into better returns for your clients. What about you, Alan? Do you agree for that with number 6, basic vertical spreads?
Yeah, I do, Mark. And quite frankly, I think, anytime you're trying to hedge a client portfolio, and having been an advisor in my past, I know there's always a reluctance where the client wants the protection but doesn't want to pay the drag on the portfolio return by paying for the put. So learning how to construct a basic vertical put spread is a great way for an advisor to say, hey, you know what, we can hedge your portfolio to a certain strike price down in the marketplace, and we can do this by buying a near-term put and selling a further down and further out of the money put, and that can help quell the the abject fear of paying outright for a put.
Yes, always need to have different ways and different strategies to talk the client off the ledge, make them comfortable spending some money to lock in that protection. That's always a fight.
Exactly right. Yeah.
Alan, that's kind of the list I put together. Is there anything else you'd like to add to that list? Any other perhaps optional skills you think an advisor should bring to the table?
I think you covered it pretty well, Mark. Advisors are a savvy group, so I think anytime their clients have a need in the option space, any advisor should know that they can always reach out to the OIC, and we have a help desk at 188-OPTIONS, and any of our experts would be happy to help with any questions that an advisor might have on constructing a strategy.
All right, and Mark, take us home here in this segment. What's your take on those final 3 steps there on our list, either writing puts in lieu of long stock buy orders, or indeed the correlation of vol to option prices? I know that's probably a near and dear one to your heart, or just adopting basic vertical spreads and kind of using those simple strategies to help reduce their premium exposure, or indeed to target their hedges to specific portions of the price spectrum of the underlying.
And I would put it to basically what, my friends over at RCM will call the triple income play. I like to call the wheel play. And I think understanding how to build a portfolio that can short puts, take delivery, then short calls against that long stock, and really create a growth strategy that produces income at the same time is a real major key. And yeah, vertical spreads are super important, and really understanding what makes a debit and a credit spread so not unique of each other.
All right, so let's run down that list again really quickly just to summarize. The basic number 1 skill every advisor should have from an options perspective is how to hedge that long equity position, that long portfolio with a basic put, or indeed a put spread if they're a little bit more savvy. The number 2 skill, of course, how to write calls to generate some income from that long equity portfolio. Number 3 is how to put those two together, construct that collar position, the holy grail of the advisor's option positions, and then some of the optional ones, and indeed maybe even less optional because it is so important. Number 4 on the list, that writing of the cash secured put an additional way to generate income for your long equity portfolios. Turn those limit buy orders in the stock into an income stream for you. Why not? Just do it. It's a great thing that all advisors and indeed all retail traders who trade stocks should be doing. Number 5, of course, understand the correlation between volatility and the options you're buying and selling. You don't have to be following the VIX every day. You don't have to understand all the Vega components and things like that. But you should have some knowledge of how the two interrelate with each other, so you know when you're writing and buying options what levels you're trading, and indeed if those are high or low compared to the average in that marketplace. And number 6, basic vertical spreads. If you can understand how to use these types of positions to offset the amount of premium you're paying for either a speculative position or a hedging position, that's a very, very useful tool. So there you have it, advisors. 6 tools you should have in your arsenal if you want to be the proficient options expert for your clients, and indeed for you out there looking for an advisor, the 6 things you may want to keep in mind when you're shopping for those advisors. And now we're going to keep on rolling right on into our final segment, our listener mail segment.
Listener mail. Listeners write in. Listeners write in. Mailbox.
All right, and welcome to the listener mail segment. This is, of course, the portion of the program where you guys get your chance to join us here on the panel and get to sound off, ask your questions, give us your comments. We love to hear from you guys. First off, we have a question from C. Davis writing to us out of Portland, Maine. He writes, and a lot of you guys wrote into our network with about this episode. He writes, did you guys hear the episode of NPR's Marketplace show where the financial advisor slammed options as being, quote, riskier than penny stocks? What did you think? Here's a link to the episode in case you missed it. And again, we have a great audience. A lot of you guys wrote into this show and other programs on our network with this exact episode linked. I'm not sure if you heard it, Alan. It was the January 10th episode of NPR's Marketplace program. They had a financial advisor on there kind of counseling listeners. People were calling in. And about 15, 20 minutes into the show, a listener called in, a younger guy, and he called in saying, hey, I was trading options and I lost a bunch of money. And the host and the financial advisor proceeded to kind of lambaste him and saying, why would you do that? Don't you know options are essentially riskier than penny stocks? And essentially counseled him to kind of set it and forget it in his portfolio and, buy stocks he likes, and that's kind of it. And to let them hopefully appreciate over time. It was exactly the kind of cliche advice you hear from a lot of advisors out there. Is exactly the kind of stereotype of options that we see in a lot of the mainstream financial media as being risk additive as opposed to risk mitigating tools. I think the advisor even told the guy, he said, why would you, I mean, they didn't get into the use case. I listened to some of the show. They didn't get into the use case specifically that the guy had. I'm assuming he bought a lot of out of the money calls and they expired worthless. But the advisor told him, hey, why would you even buy an instrument that has a negative expected return like that? Or I think he said, why would you buy an insurance vehicle that has a negative expected return like that? He thought of options purely as insurance, never thinking of the fact maybe there is a value to having an insurance component to your portfolio. Completely dismissed that. It was just kind of a reminder that still quite a bit of the financial advisor audience and still quite a bit of the mainstream financial media still is locked in this, late 20th century mindset of options being very, very risk additive type tools. I'm sure this doesn't really surprise you, Alan. You spend a lot of your days going around the country talking to advisors in different outlets, and this is still a very prevalent mindset. Is that pretty much what your take as well?
Well, yes, and I can't really comment on this particular show because I hadn't heard the particulars of what the financial advisor had said. But I will say this, that OIC in its education really does not discuss options as being a speculative instrument, and for obvious reasons. I mean, if you're buying far out of the money calls, anyone can understand that you have a very small percentage of the time that stock will appreciate to that strike price. However, for all of the reasons we talked about earlier in the tricks of the trade, hedging, writing covered calls, selling cash secured puts, I would love to get into a debate with this person on the NPR and discuss where he feels that this possibly could be conceived as being riskier than penny stocks. So That's all I can say about that.
I think if you just showed up with the results of your collar studies and showed them that, lower volatility, lowered standard deviation, the same, if not better returns than owning the underlying outright, it's kind of hard to argue with it.
Yeah. And truthfully, we've had a tremendous run in the overall markets in 2013, up nearly 30%. So, obviously the buy hold and the adherence to that kind of organic investing is very strong right now, because there isn't a whole lot of fear of the market going back down at the moment.
Yes, that's the unfortunate side effect of these extended bull markets, is it turns everyone into a savvy financial guru. Even the laziest financial advisor who put his client in one thing and forgot about it did pretty well last year. So it kind of reinforces that buy and hold mentality, which I think is kind of unfortunate. I think if you're out there and you're paying for a financial advisor and they're telling you just to sit on your hands and set it and forget it, I think you probably want to look elsewhere for the most part. I mean, there is a little bit of logic to that if you have a client who's just constantly trading in and out all day and causing themselves all kinds of friction and slippage costs. Maybe you want to tell them to dial it back a little bit. But if you're a financial advisor, you have an obligation to do more than just sit on your hands. You really need to be doing things like we're talking about here. You need to be generating income for your client. You need to be hedging their risks in the broad market. You can't just buy a stock you think is good over the long term, stick it in an IRA, and you're done. That's really just the beginning of the story, and you didn't even do it right there. You should have written a put to do it that way instead. So, and moral of the story, Mr. C. Davis, thanks for writing in. A lot of you guys did. We did hear this episode, and it does kind of unfortunately reinforce a lot of those negative stereotypes, which is exactly why a show like this exists. You should write into NPR, send them a link to this show, and say, hey, here's what financial advisors should reasonably be doing in this environment. All right, next up. We have a question from Mr. Dog Fan. This is an interesting one. I don't know, Alan. We'll see how much you can discuss from your purview over there as the director of education at OIC. But it's an interesting question. I was hoping Mr. Kavanaugh and some of the RCM guys would be on as well to get into some of the more specifics of kind of the fee schedule. But what Mr. Dog Fan writes is, how much should I reasonably expect to pay for a financial advisor who can do all of the things you guys discuss? Is there a set percentage or rule of thumb that I should go by? I imagine all of these skills would result in very, very hefty fees. So, Mr. Dog Fan, you might think you have to pay more for these types of skills, but as we just outlined in the Tricks of the Trade segment, these are actually things you should reasonably come to expect from your financial advisor. These should be built into your existing fee structure. So someone tries to turn around to you and says, well, we're going to charge you orders of magnitude more because we have these extra skill sets. I think you probably should look elsewhere. I mean, your advisors traditionally have gotten by with their standard percentages and their standard skill sets, doing what essentially amounts to the bare minimum, putting you in these spreadsheets that diversify you among 30% fixed income, let's say 60% equity, and then maybe if they're really crazy, 10% in commodity or something like that. And they figured that was the bulk of their work that they had done to earn their percentage. We here on this show think they should do a little bit more to earn that percentage, including having all of the skill sets here above. So if you find an advisor, or if you are an advisor and you're using these to try to charge an arm and a leg, I think there are other people out there who will do this and do as good of a job for the same amount, if not less. Alan, what's your take on the fee structure in general? I know you're kind of limited in all the things you could say over there, but what's your general response to our listener here?
Well, in general, you have two types of advisors, right? You have a fee-based advisor, you have a commission-based advisor. So on the commission side, I guess it's, dependent upon what you're doing with that advisor, he's going to charge you a commission. If it's a fee-based, it's all rolled up into one separate fee. Additionally, don't rule out, Dog Fan, that you might want to ask your advisor to do a strategy, any of the strategies we talked about earlier, with a sub-advisor or a manager who can do a systematic call writing program. And there are many, many good ones out there. So that would just be an additional bucket, if you will, within the confines of your portfolio.
Yeah, and you're right. Of course, there are those advisors that are more transactional oriented, and indeed, if they're passing those commissions along to you, if they're doing a little bit more trading here, like we said, writing puts, writing calls, buying puts, that sort of thing, there probably will be some more commissions passed along to you. But at the end of the day, if they're doing it right in the ways we've outlined on this show, that should translate into better returns overall for you. So at the end of the day, you're still coming out ahead. But it's a great question, Mr. Dog Fan. Unfortunately, we don't have specific numbers we can throw out to you on that. But in general, these are the skill sets you should be looking for, and you shouldn't be charged an arm and a leg for them outside of the pass along of the general commissions. All right, and that, unfortunately, is all the time we have for the Advisors Option program for today. I want to thank Alan and, of course, Mark for joining us today. And before we go, let me check in with each of my cohorts, and they're my partners in crime here, to see what they have cooking in their respective necks of the woods that may interest you. Now, I know, Alan, you guys over there at OIC announced a really big initiative this year. Why don't you walk our listeners through what you guys have cooking here for 2014?
Well, we're pretty excited about it. Thanks, Mark. We have a new advertising campaign, if you will, but it's also coupled with a new advertising campaign is a whole new educational program called the Options Educational Program, or OEP. And what it is if you go to our website, optionseducation.org, you can actually find core components of our program, which is customized education with MyPath, an assessment tool. And anyone who goes and takes part in the program can go through comprehensive courses, podcasts, videos, and then after a period of time, you can take an exam. Now, this isn't a licensing exam, but it's a certificate of completion where you can say that you've accumulated a certain level of knowledge about options and option strategies. So we're very excited about that. Listeners might glean that this is very similar to something like a Coursera or a MOOC, some of these online universities, what they offer, sans the actual degree. So we're very excited about that. We're also right in the very early stages of a mobile app that OIC is putting out, and it will be launched on the Apple iTunes Store, and it will give you connectivity back to our core curriculum, as well as information about any of our webinars or any of our local seminars, evening seminars in a city near you.
All right, thank you for that, Alan. And Mr. Sebastian, what is cooking over there at Swan Wealth Advisors?
We're excited for 2014. We are, pushing forward with our, smart income strategies. We recently hired a guy named Pat Stiefel, who's our new director of execution. He was an old SPX guy. I don't know if you know him or not. He was SPF. And we're excited to have him on board. And we're just super excited about all the different initiatives we're running at Swan.
Love the Swan guys. They're just poaching all the good Chicago talent, but it's good to see. Good to see they know to go to the right place for their options knowledge.
It is.
All right, and that is going to do it for this episode of The Advisor's Option. And on behalf of Mark and Alan and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we're looking forward to many more episodes coming your way in 2014.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.